Money, Money, Money Insurance Special, co-presented by Exide Life Insurance.
Hello and welcome. You're watching Money, Money, Money. I'm Sumaira Abdi. Now, insurance is perhaps the least understood and the most missold product there is. And I often wonder why that is, because to my mind, insurance is so simple. It's a risk cover that provides protection against a possible eventuality. It's by no means an investment. The key to understanding is what it does and why you need it. Therefore, it is our endeavor at Money, Money, Money to simplify the world of insurance for you and debunk many of the myths associated with it. It's in line with this that Money, Money, Money has now launched an 8-week-long initiative that will focus only on helping you with your insurance needs. So through these 8 weeks or 8 episodes, we're going to cover not just life insurance, but also home, medical, accident, travel, and even insurance for white goods. So this week, as we kick off the insurance series, we focus on the most basic first: traditional insurance plans versus the term plan. Pankaj Matwal of Optima Money Managers is our guide this week. Pankaj, thanks as always for joining in, and thanks very much for kicking off this initiative with us. Now, insurance, I know, is something that you track very closely as well, right? So let's get started first, because it's ironical that something which is so critical to somebody's financial plan as insurance is so misunderstood, right? It's often mistaken to be an investment choice rather than just being a risk cover. So why don't you start off by telling us what exactly is a traditional plan, the endowment, whole life, money back, ULIP? What's the difference between all of these and a term plan?
See, most important first thing is to understand why insurance and what is insurance. See, key objective of insurance, or especially life insurance, is to protect the future income in case of untimely death of the breadwinner. So therefore, one should buy a insurance cover so that in case eventuality happens, his family gets a sufficient money so that they can survive on that money throughout their life. Now here what happens, as I said, that term insurance, endowment, money back, different kind of policies. See, as I said, objective is to have the proper money, adequate money after death of the breadwinner. But the death is something people don't agree or don't believe in that I will die tomorrow. Okay, so people feel that if I buy an insurance policy which gives only life cover after my death, which gives only money after my death, and I'm not going to die throughout my term, so it means total premium what I'm paying will go waste. So that is why people prefer buying policies which has something insurance as well as investment. So therefore, these kind of policies what you spoke about, endowment, money bag, ULIP, these comes in picture. So these policies are basically combination of investment and insurance. Then in that also there are different features, like if a policy is there which says that you pay premium for next 20 year, 25 year, whatever the term of the policy, and at the end of the term you will get that sum assured along with some additional benefits like bonus or some guaranteed addition. So it is an endowment policy. Now person thinks that 20 year I have to wait. Why not in between I should get something? Yeah. So that is why insurance companies have designed some product like money back policy. So it is a kind of endowment only, or it is an anticipatory endowment where at a periodically you are getting some money out of that sum assured. Then in this also, if the question is like child plan. Now child plan also same thing. If something happens to the policy holder who has bought the policy, who is the life assured, in that case his family, and in that case because I'm saying child plan, so child will get benefit or that sum assured in the policy. So it is no difference, but the name has been given like a child plan, and they have designed in such a way that you will get money when the child is 18 years, 20 years, something, keeping the child's need in mind. So means basically these are combination of insurance and investment, and keeping in mind that need of a person, they have designed the products. So there can be many products like even a whole life plan where the person will get the sum assured which in the policy remain intact throughout the life whenever person dies, because if you talk about a term insurance which has a term of 20 years, so after 20 years if person dies, in that case his family members will not get anything because term is over. But if you have bought a whole life policy, so anytime before 100 years of age, when person dies, his family members will get the sum assured. So these are basically differently designed, these feature or products with a different feature, but objective is same, that in case of death, the family member should get financial support from the insurance company.
But in that case, don't you think at some point we're missing the point? Because see, in a term plan, while you're very young, your premium is also very low, right? But therefore, the term may be over quite soon. Okay, as opposed to if I was to delay taking a term plan because I want to maintain the term for longer, which is when I'm more likely to die, the premium will be very, very high. So doesn't the argument sort of defeat the purpose?
Sumera, very good question. But when I said objective of insurance to protect income, so usually people retire at the age of 60, 65. So one should not buy an insurance cover beyond that age. Means insurance cover should also end at the age of 60, 65. So a person who is 30 years old, he can easily get a term of 30 years, 35 years. Nowadays policies are available. Term insurance plans are available with the term of 30, 35 years. So I don't think that there is a problem. Person buys at 25 years of age or 30 years of age. Rather, I'll say in case of endowment plan, the term is hardly 20-25 years. So in that case, if a 25-year-old person buys an endowment plan, the term will be over by 50 years of age. So what in that case? How he'll buy another policy, whether endowment or whether term insurance? So it is better to buy term insurance actually because the longer term is available in case of term insurance policy.
And that's a very valid point. In fact, viewers, you need to note over here that you're actually buying a term plan not just to get the money when you die, but to actually protect the years when you're earning. And that's the income that you're actually insuring, or your ability to earn, right? Another argument that can be made in favor of the traditional policies that a lot of people I hear have been making is that you get roughly about 7% return, right? Now, if I was to put that money in a PPF, say, I'd get 8.7%. In a bank FD, I'd get even lower. So is it not enough that I sacrifice about 300 basis points of returns and get a risk cover?
See, in any insurance policy, if it is a traditional plan, other than ULIP, there is no transparency. But one thing is sure that they will have marketing cost, they will have mortality charges, and whatever the remaining premium or what we call investable premium, that will only be invested and will give you returns. In ULIPs, you get transparency. You know that how much money is going towards what charges and how much is going towards investment. Now, in your plan like endowment or money bag, after deducting these all charges, balance will only be invested. Now, mostly because these plans, though not guaranteed, but yes, sum assured is guaranteed and they give you bonus. So, money cannot be invested in equity or full amount in the equity. So, definitely they will invest in the government securities, bond, etc. So, you cannot get very high return there. There is a limitation, there is a limited scope of generating good returns. Second thing, as you said, 6-7%, that is also not guaranteed, 6-7%. Now, if I say you buy a term insurance policy, and in term insurance policy, you pay very small premium. Say for 1 crore rupee, you pay 10,000 rupees. But if you want to buy 1 crore rupees endowment plan, one thing, you won't be able to afford it. Because simply for 1 lakh, premium comes around 10,000 rupees. So think about that, paying 10 lakh rupees for 1 crore policy. I don't think that anybody will really willing to pay or will be able to afford it. So second thing, then what happens? Usually people buy a plan with lesser sum assured. So buying a policy with 1 lakh cover or 10 lakh cover does not serve the purpose of insurance. So you are not adequately insured. So that is why this argument is not correct that people should invest in insurance policies. But when they invest, they will invest in with a less sum assured, which will not serve the purpose of insurance. So in my opinion, it is always better to have two things separate. One is term and then your investment. One more thing I want to highlight here is not only the argument of returns. See what happens today, a person may think that he can pay high premium also, and he has bought a policy for next 25 years. Now nobody knows, in life there may be some ups and downs. In case he is not able to afford premium in future, he stops paying premium, so neither insurance remains intact nor his investment will remain there. But suppose he has bought term insurance and and investment separate, and he is not able to pay high money for investment, but at least he can continue his term insurance.
That's a very valid point, and that actually brings me to my last question, is that there is no surrender value at all for a term plan, right? So if someone, I know it's a small amount and mostly people would continue with their term plan, but in the eventuality and for the sake of argument, if somebody stops paying the premium on their term plan, what happens? And is there any possibility where you still get some sort of surrender? Are there any plans where you'd still get something back?
See, in term insurance also you have single premium policies, limited premium policies, as well as regular premium policies, and also you have policies where you get your premium return at the end of term. So that we call with return of premium policies, but premium is much higher in those cases. Okay. So here, if you surrender those kind of policy where you are paying higher premium or where there is a single premium policy, you may get some small surrender value. But still, I'll say if you compare it, you'll find that the policy which does not give any surrender value and which is a regular premium policy is basically, it makes more sense if you calculate actual returns on that.
That's true actually, and as someone said, I don't want to sound grim, but there are only two things which are certain in life: death and taxes. Alright, on that note, it's time for us to take a very quick break. When we come back, Pankaj is going to stay on with us and he's actually going to answer some of the queries sent in by our viewers. Do stay tuned.
Money, Money, Money Insurance Special, co-presented by Exide Life Insurance.